First of all, thank you so much for joining our very first ever webinar. We've done tons of seminars and workshops over the years, and we've also done a lot of teleconferences, but this is our first actual webinar. Really what I wanted to do is just kind of summarize what has just occurred with the American Taxpayer Relief Act of 2012, which if you look at it, it really reshaped the tax landscape for this year and beyond, because the new tax law, it includes a range of both tax relief and tax increases at the same time, and that's what we're going to be taking a look at today. If you think about it, there's really nothing more, or really nothing like a deadline that we saw looming at the end of the year to force Congress to take action, and that's exactly what we saw over the New Year's holiday. Pretty much a dramatic year-end debate, everybody talking about the so-called fiscal cliff that preceded the enactment of this American Taxpayer Relief Act of 2012, or ATRA for short, or ATRA, American Taxpayer Relief Act. And now that a lot of the reports about the tax law have kind of died down, we thought it was a good time to take a look, or a closer look, at how this may affect your personal situation. Also at the end, if I can figure out how to do it, we've done some trial runs. If I can figure out how to do it, I'll take questions at the end. Worst case, feel free to call in this afternoon or Monday. We'll be glad to answer your questions one-on-one. But I'm going to try at the end if I can make it work. Sometimes I'm a little technologically challenged, but I'll see if we can make it work and take questions at the end if at all possible. We're going to be starting out by talking about income taxes, and for most people, really at the end of the day, this is going to mean little change for you in most cases, but I want to cover what those changes are. In some cases, they're pretty favorable. In some cases, for the higher earners, they're not so favorable. I'm going to start by talking about the individual tax rates, the marginal rates. Pre-EGTRA, which is the Tax Relief Act that came out in 2001, the rates were 15%, 28%, 31%, 36%, and 39.6%. And those rates during the Bush tax cut years were slashed to 10%, 15%, 25%, 28%, 33%, and 35%. Now what basically happened as a result of the new law, it kept the 2012 tax rates the same rather than them reverting back to the Clinton era rates, the pre-EGTRA rates. So they're back to the same as they've been several years, except for the addition of a new top bracket of 39.6%, and that rate bracket begins this year in 2013. So that's, in my mind, one of the biggest changes is the top bracket's going from 35% to 39.6%, and that does not include the effect of some of the exemption and phase-outs that are going to occur for higher income earners. It really brings that tax rate a little bit higher, or the effective rate, and then there's also a surtax we'll talk about a little bit later. So there's some other things that for top earners are really making it an even higher incremental change than that 35 to 39.6% rate increase for the top bracket really reflects by itself. So the new 39.6% rate applies to taxable income above a pretty high threshold. So for most taxpayers, you can kind of take a deep breath of relief, or a sigh of relief, I should say, that in many cases income taxes won't increase. And because that rate schedule is graduated, taxpayers whose income falls within the 39.6% bracket are still going to benefit from the lower rates below the thresholds, which are $400,000 for single filers, $450,000 for a married couple filing a joint return, $425,000 for head of household, and married filing separately is $225,000. So especially for higher net worth folks, this jump in the top rate of almost 5 percentage points, not to mention some of the other things I talked about earlier, some of the phase-outs I mentioned a minute ago, and the surtax that I alluded to. It's a pretty substantial increase for those higher income earners, especially somebody that's a owner of a small business or a professional making in excess of those amounts is probably going to see a pretty heavy increase at the end of the day, especially those with business income that transfers on to their personal tax return. Those folks are definitely going to likely be affected. So what are some of the things that you can do to sidestep or defer taxes? One of the things that you can do is fully fund retirement plans. And of course, we've preached this for years. If you're working somewhere and you have a 401k, or you work for a nonprofit and you have a 403b plan or some similar employer-sponsored plan, by putting those dollars into that plan on a pre-tax basis, you effectively lower your taxable income for that year, and you're basically deferring the taxes until you take that income out later on in retirement. So that's one way that you can help sidestep or defer taxes. Another is to defer compensation. A lot of companies will have non-qualified deferred compensation plans where it's similar to a 401k, but you're deferring income by putting it into a non-qualified plan, thus lowering your income now, putting it into a retirement account so you can take it out later when you need that additional income. And then a third way is just to review your investments. And I think now is a great time to meet with us to kind of evaluate where your holdings are, how you're allocated, especially with your non-IRA, what we call non-qualified assets. It's a great time to make sure those are positioned in such a way to take advantage of some of the tax efficiencies that are potentially out there and available to you. Now, there's also a return of two other previously expired provisions that effectively increase the tax rates for higher income taxpayers. One is the personal exemption phase-out. It's one of the things I was alluding to earlier. It reduces, possibly to zero, the amount that taxpayers can deduct for personal exemptions as adjusted gross income, or AGI for short, adjusted gross income, exceeds certain thresholds. So it phases those out, so to speak. And then number two, the other, it's named the PEPPEASE limitation, and that's named after a gentleman. That's his last name. I'm not even sure if I'm pronouncing that right, but he's the lawmaker that originally championed this thing. And it places basically what it does, and I shouldn't have said championed it. It's probably not the best terminology, but it places an overall limitation on itemized deductions. So it basically starts taking away deductions and effectively increasing taxes at the same time. And that new threshold for both the personal exemption phase-out and the itemized deduction limitation are significantly lower than the thresholds for the 39.6% bracket. So these are going to affect a lot more people. In other words, you don't have to be at those higher levels in that highest bracket to be affected by these phase-outs. So for single taxpayers, it begins with adjusted gross income over $250,000. Married couples filing joint returns $300,000. Head of household $275,000, and married filing separately $150,000. So as you can see, it comes in sooner than the highest bracket does. The itemized deduction limitation, if it affects you, the limitation on itemized deductions could be particularly harsh because you can lose up to 80% of common itemized tax deductions, like home mortgage interest. For those of you that are not in Texas, state income taxes, if you have a state income tax where you reside. A few of the deductions are accepted, including medical expenses and casualty losses. Basically, the deductions are reduced by 3% of the amount by which AGI exceeds the thresholds that were discussed a moment ago. So the amounts above that are subject to this 3% reduction. Because above-the-line deductions reduce your adjusted gross income rather than being subtracted from adjusted gross income, they can actually limit your exposure to the personal exemption phase-out and the itemized deduction limitation, and potentially this can help you qualify for other tax breaks that are limited by adjusted gross income as well. So some of the examples of above-the-line deductions, not common in Texas, but alimony is one. Self-employed health insurance premiums is another above-the-line deduction. Self-employed retirement plan contributions is one. And if you qualify for a tax-deductible IRA contribution, that's another one. And certainly check with us, because I've had a lot of clients over the last few years that were surprised to learn that they did, in fact, now qualify for a tax-deductible IRA, whereas in the past they might not have, especially if you've retired and maybe you have some part-time work, or maybe you're not even working but your spouse is, and especially if you either have a plan at work and your income's not too high, and I say too high because there's some phase-outs, or if neither of you have a plan at work, then you're likely to qualify as long as one of you has some earned income, meaning from a job, whether you're self-employed, independent contractor income, or actual W-2 income. Then you may very well qualify for the IRA deduction. And I was going to mention the amount later as I go through some of the changes, but it's $5,500 this year, $5,500 each. And if you're 50 or older, there's another $1,000, so it's $6,500 each. The only thing is you cannot contribute more than 100% of what you make. So it's 100% of earned income up to $5,500 or $6,500 if you're 55 or older. All right, moving on to the next slide. Let's talk about capital gains and dividends. And this has been up in the air for a while now. And everybody's been waiting for the capital gains rates, the long-term capital gains rates to increase. As a matter of fact, a lot of our clients have told us that their CPAs have been encouraging them over the last couple of years if they had highly concentrated positions in stock, especially those of you that have worked or did work maybe previously or still work for a large employer, and you've got company stock and you've got a high percentage of your net worth in that company stock, any company stock for that matter. But it's very common for those that work for large corporations for a number of years to have accumulated a lot of stock with that company. And some of you have been reluctant to diversify it for fear of paying the tax. Well, a lot of CPAs have been encouraging clients to, if they were ever going to do that, do it prior to this year because it was set to go up to 20% this year. But as things turned out, I think it's really a nice change in this new tax law. Basically, it's good news for most taxpayers because prior to the American Taxpayer Relief Act, the rate on most long-term capital gains was going to go to 20%, as I said, and then qualified dividends were going to be taxed at your ordinary income tax bracket rate, which could be as high as 39.6% this year. So for most individual taxpayers, this American Taxpayer Relief Act makes permanent the 15% maximum tax rate on most long-term capital gains and keeps the preferential tax treatment of qualified dividends that investors have enjoyed the last several years. So it's basically protected that. The 0% capital gain and dividend rate remains in place for anybody under the 25% tax bracket. So those in the 10, 15% bracket will pay no capital gains tax if they liquidate something subject to long-term capital gains, whether it's a piece of real estate or a stock or a mutual fund or what have you. So that was very good news, but not everybody's going to benefit from that 15% rate or the 0% rate in some cases. Those that are in the highest bracket, the 39.6% bracket, are going to see a 20% long-term capital gains rate starting in 2013. So basically, it did go up, but only for those in the highest bracket, which is good news for most of our clients. Okay, so let's talk about how you can make the most of the favorable rates. One, whatever your income, you're going to want to make the most of the favorable rates on capital gains and qualified dividends, if at all possible. And a way to do that, obviously, is to review your portfolio. And we can certainly help you do that. And where appropriate, put more of your portfolio in investments that have the potential to generate capital gains, long-term capital gains, and qualified dividends. And at the same time, when I say that, we obviously want to make sure that the tax savings are worth any potential additional risk that might be incurred by doing that. And also, this comes up a lot. What I'm referring to when I talk about long-term capital gains, that doesn't apply to retirement accounts like IRAs, 401ks, 403bs, basically any employer-sponsored retirement plan or an IRA. Because it's tax deferred and you're deferring the tax until later, when you take that income out later, it's taxed at ordinary income rate, so you don't have capital gains or capital losses in IRAs. And that question comes up, it seems like, on a weekly basis. So this would be on your non-IRA assets, would be an easy way to put it, your non-tax deferred, non-retirement accounts. And then secondly, you want to be careful of holding periods. You want to watch out for holding periods. The 20, 15, and 0% rates on capital gains, those apply to investments held for the long-term holding period, which is more than 1 year, and then also to inherited assets. So a gain on a subsequent sale is automatically considered long-term if it was a recently inherited asset. Now, similarly, dividend income is taxed at the favorable rates only when the shares have been held for a minimum period. And this is always hard to follow, but that minimum period is generally for more than 60 days during the 121-day period that begins 60 days before the stock's ex-dividend date. So that's always a mouthful when I say that, and you can always ask me later to re-clarify that if you're curious if that applies to you or not. All right, let's talk about another strategy that this doesn't fit a whole lot of cases, but when it does fit, it is a really nice fit, and it's called a CRT, or a Charitable Remainder Trust. So let's say you own a highly appreciated investment. It could be a piece of real estate. Maybe you've had a farm for a number of years, a piece of ranch land, or even a stock that you bought at X, and now it's worth a whole lot more than X. And you'd like to diversify your holdings, but defer the tax impact. Well, you'd think, well, you can't do that. How can I diversify this holding, liquidate it, and put it elsewhere so it's not so concentrated, and avoid the tax at the same time? Well, you can, in certain instances, do that by using a charitable remainder trust, or CRT for short. What it does, a CRT can provide you or a non-charitable beneficiary with a lifetime income stream. And at the end of the term of the trust, the remaining trust assets pass to that qualified charity, or charities, it could be multiple, that you've designated. But the value of your charitable gift is tax deductible in the year you establish the trust. Okay, so there's some tax law limits, there's some limitations. This is just my opinion, but it generally works if we're talking about at least a couple of $100,000 or more. And if you have a stock that you paid $2,000 for and it's worth $50,000 now, it's probably not worth the expense of setting up the trust to do it. But like I said, when it fits, like I've run across people that have Exxon stock, that the basis is really, really low. It's just grown tremendously over many years, and they don't like having that much in that concentrated stock position, but at the same time, they don't want to pay the tax. This could be a fit, and if it fits, it really works nicely, because instead of liquidating so that you can diversify and paying a bunch of tax, you get to liquidate and diversify and get a tax deduction. So that the benefit goes to you rather than to the IRS. So if you want to know more about that, just holler at us, and we'd be glad to see if it fits your situation or not. Now, this is a big one that really, I think, it surprised a lot of people. The alternative minimum tax, we saw a lot of relief in this area, and it's a pretty favorable move, especially for middle-income taxpayers. The new law provides alternative minimum tax relief by permanently raising the AMT exemptions and then indexing those exemptions for inflation. So if you have the benefit of the slide, and I'll go ahead and say the numbers out loud for those of you that don't, under the prior law, for a single filer, that dollar amount was $33,750. Above that, you were potentially subject to AMT. And basically, AMT is basically a tax that says, if you're not paying enough, we, the IRS, and I'm going to give you kind of my corny explanation of it, but we, the IRS, think that if you make above this level, you need to pay a certain percentage in tax. And if after you calculate your taxes on your return, it's not at least X percent, we're going to charge you enough to bring you up to the percent we think you should have paid. That's my rough explanation of AMT. So it was at $33,750 for single filers. It was at $45,000 for married filing jointly. Now, under the new law, it jumped from $33,750 for a single filer up to $51,900, so not quite 2 times, but almost. And it jumped from $45,000 for a married couple filing jointly to $80,800. So again, not quite 2 times, but almost. So the AMT, it's basically an alternate tax that was intended to ensure that high-income individuals paid at least a minimum amount of tax, but it's just been affecting more and more taxpayers over the years. And the pre-ATRA, American Taxpayer Relief Act exemption levels scheduled for 2013, it was going to affect millions of middle-income taxpayers. And it's estimated that about 28 million taxpayers are going to be protected through this change in the tax law. So this was one of the biggest, and I think for many people, they'd tell you the most surprising in this act that we saw out of all the changes that came as a result of the Taxpayer Relief Act. Okay, let's talk briefly about child-related provisions. First being, there's a child tax credit cap fixed at $1,000 per child. This is for each qualifying child under age 17. Without the new law, the maximum credit would have shrunk to $500 per child in 2013 and beyond, so basically doubled it. Then the caps on the amount of work-related child and dependent care expenses that can qualify for the dependent care tax credit: $3,000 for the care of one person, $6,000 for two or more, and the credit rate, a minimum of 20% of eligible expenses, remain at their current levels instead of being reduced after 2012 as the prior law would have required. The tax exclusion for employer-provided adoption assistance is also made permanent. So in situations where that applies, that's a nice change as well. Okay, then there's also some education incentives I'm going to cover real quickly. The Taxpayer Relief Act extends several of those provisions, and those can give parents a hand with reducing income taxes and financing a child's education. Some of them are extended permanently, and others are just for a limited period of time. The rules limiting the deduction for student loan interest after 2012 to the first 60 months of required interest payments, and then placing lower income limits on the deduction, those will not be reinstated. So this was good news. In other words, they're continuing to allow that rather than limiting the deduction. The annual limit on contributions to Coverdell Education Savings Account stays at $2,000. That was scheduled to drop to $500. Still a low amount, but at least it's $2,000 as opposed to $500. I'm surprised they didn't raise that to match the traditional IRA contribution amounts, but at any rate, at least it's $2,000 as opposed to $500. And then account funds can continue to be withdrawn for qualifying elementary and secondary school expenses, as well as for higher education expenses. So they've continued to allow it for even elementary and secondary school expenses, whereas some college savings plans are only for higher education. In addition, the American Opportunity Tax Credit, I should say, and the above-the-line deduction for qualified tuition expenses, those are extended temporarily. For employees, the exclusion for up to $5,250 of employer-provided educational assistance, that's made permanent, and the deduction for up to $250 of out-of-pocket classroom expenditures for K through 12 teachers, that's also extended as well. So extended but not made permanent. So if you're a teacher on the line, that's good news for you, because I know a lot of teachers will spend some out-of-pocket money, and that's nice that they kept that provision, at least for now. Okay, let's talk about some of the other changes. There's 3 other temporary extensions that may help reduce your 2013 tax bill. If it will be beneficial, you can elect to deduct state and local general sales taxes as an itemized deduction. Unless it's extended again, though, this provision expires after 2013. But it seems like they just keep bumping this out, so maybe they'll just keep doing it 1 year at a time. Then the credit for certain energy-efficient home improvements and equipment expenditures, that's extended as well through 2013. And then thirdly, more liberal deduction limits for charitable donation and qualifying interest in real property, including the special rules for qualified conservation contributions by corporate farmers and ranchers. Doesn't apply to a lot of our clients, obviously, but those remain in place as well, so this was good news for those folks. And it's through 2013 that will remain in effect. Okay, now let's move into estate and gift taxes. This was one of the big ones that's kind of been on the table the last several years, and everybody's been real curious what was going to happen with the estate and gift tax laws. I think this one's pretty welcomed because the new law brings a measure of planning certainty. Because it's been so up in the air, a lot of estate planners have just kind of been, what do we do? I mean, it's hard to plan for the future when you don't know what the future tax laws are going to be. But there's some permanency in this. They say they've made it permanent, but always realize when we're talking about Congress and taxes, permanent basically means it's permanent until they change their mind. But at least for now, they've said the word permanent. You can, in many cases now, opt for a simpler estate plan as a result of all this. Basically what we're hearing from estate planning attorneys, if ever there was a time, it is now to simplify, simplify, simplify. So if you've got some estate planning that you did 5 or 10 years ago and you have trusts in place, depending on why you established those trusts to begin with, you may or may not need those trusts any longer. And I'm not saying abandon all your trusts. I'm not saying that at all, because trusts still have a place in many, many cases. When they fit, they're really needed. But a lot of folks have put trusts in place along with their estate planning documents to help avoid the effects of estate taxes at death. And in many cases, that is not necessary anymore, and you may be placing an unnecessary burden on your heirs if that was one of your motivators for trust planning. You may not need that anymore. So if nothing else, it's a great time to review. We'll be certainly glad to talk about it with you in financial reviews that may in turn refer you out to an estate planning firm to see if you need to make any changes or drop or amend any trust that you might have in place. Instead of falling to $1 million in 2013 as previously scheduled, and basically I'm referring to the exemption amount, the amount that you could pass to your heirs without tax. So in that case, an amount falling was not a good thing. Instead of it falling to $1 million, which it was previously scheduled to do, the cumulative amount that's exempted from federal, estate, and gift taxes, we call this the basic exclusion amount. It's permanently set at $5 million. And it's also indexed for inflation after 2011. So the exclusion amount for 2013 is $5.25 million, which means a married couple can effectively transfer up to $10.5 million, both estate and gift tax free. But I want to make, that causes a lot of confusion. I want to make one point clear. Think of it like a fork in the road, and both forks apply to you. So in this case, you actually have to potentially drive down both forks. And that, what I'm referring to is one fork in the road, let's call it the left fork, is estate taxes. The right fork is income taxes. They're two completely different types of taxes. So it does not mean that if you're a married couple and you're under $10.5 million, that your heirs won't pay any taxes when you die. It means they won't likely pay any estate taxes. But income taxes are a totally different animal. That's the other fork. So if you've got assets, and retirement accounts are a perfect example. Let's say, and a lot of retirees, the bulk of their net worth is in retirement accounts, IRAs, 401ks, etc. For the most part, that money has probably, most of it, if not all of it, never been taxed before for income tax purposes. So if you pass away, let's say you and your spouse pass away and you're under the $10.5 million, and you're thinking, oh, well, we're tax-free. We're under 10.5. You would be right as that pertains to estate taxes, but that does not have anything to do with income taxes. So that money is potentially taxable to your heirs. Now, there's ways around that being taxed completely. If it's set up correctly and if your heirs work with us and handle it correctly, or work with somebody that can help them set it up properly, they don't have to pay all the taxes at death. They can spread out taxes on retirement accounts over their entire life expectancy if they do it right. But basically, I'm saying the IRS has a bite at that apple or a piece of that pie that they're going to get regardless of whether you pay estate tax or not. Now, if you were over the estate tax exempted amount, you might also have estate tax. But just always remember, they're two completely different taxes. Estate taxes are nothing more than a right for the government to tax you on your right to transfer money to your heirs at death. It's a transfer tax is really what it is. Also, there is something that a lot of people aren't aware of. At first death, if you're married, at first death, there's an unlimited marital deduction. That means you can pass as much, you could pass $100 million to each other, no problem. It's on that second death that you could have a problem. What they've also done is they've basically put those two together so that there's a portability election provision. That was set to expire, but the provision allows estates of married individuals to make an election to transfer any exclusion amount not used by the estate to the surviving spouse. So basically, that's why it goes from $5.25 million to $10.5 million. Years ago, you had to have certain trust planning to make that happen. Or after the first death, if you had an I love you will, gave everything to your spouse, when they passed away, they only had, for example, a few years ago, the exclusion amount was $600,000. If you didn't have any estate planning, you pass away. Let's just use husband as an example. Husband passes away, leaves everything to wife. Wife passes away. Anything over $600,000 was potentially taxed if they had not done any trust planning in advance. Now, there's some rare cases where you might still need a trust in place in this regard, but for other reasons. Maybe you think the estate's going to have a lot of growth or something of that nature. But that amount will be protected even though it passes to the spouse, and that surviving spouse can pass not just the $5.25 million or whatever it is in the future, since it's indexed for inflation. It's $10.5 million this year and then indexed for inflation. So it basically allows you to double it, is what I'm trying to say, without the need for a bypass trust. There's other reasons why you might want to bypass trust, so don't just assume that you don't need one, but in many cases you will not need one, whereas in the past that was the only way to double what you passed at the second death. Also, the maximum rate on estate taxes did go from 35% to 40% this year and beyond. But under the prior law, it's set to go to 55%. So yes, it was an increase, but it's a heck of a lot better than it was scheduled to do at 55% under the prior law. That's what it was set to go to. So you don't want to hesitate to plan when it comes to estate tax planning, because taxes are just one aspect of estate planning. A lot of times when we talk about estate planning, clients are thinking estate tax, oh, I don't need any estate planning. I've got less than, well, now $10.5 million or 5 1/4 if you're single. That's just one aspect. Generally, the main objective of an estate plan is to make sure that your family and your other loved ones have money passed to them in the manner that you want, and that the assets are transferred and managed and distributed like you want them to be, not whatever the probate statutes say. So that's the primary reason to have a will. You're telling the courts what you want to happen rather than the probate statutes. Basically, each state has their set of kind of a hierarchy of who they think should get your money in what order. Well, you get to dictate in your will who gets it and when and in what order. So you still need estate planning even if you don't have an estate tax problem. You also need, we talk about this all the time in reviews, but I think I can't preach this enough, the importance of your living documents. And what I'm referring to are your powers of attorney, both financial and healthcare, your living will, which has to do with life support. Those are living documents. Those can affect you, and if you're married, your spouse, while you're living. The will makes it easier for everybody else when you're gone, but these power of attorney and living will documents make things smoother and easier for the rest of your family while you're living if something were to happen. And one of the big things that we see sometimes is adult guardianship. And if you don't have a power of attorney in place, you could be in a situation where you or your spouse has to apply to be the legal guardian of your own spouse because you didn't get around to getting a power of attorney document. And you also want to get those updated every few years, because unlike a will, which is rarely, if ever, turned down by a judge because it's too old, I don't think I've ever heard of that happening. Now, I've heard of them not honoring a copy of a will. I've seen them honor copies, and I've seen them say, no, I can't, I've got to have an original. But with powers of attorney, those are presented to financial institutions or a healthcare power of attorney to a hospital or a doctor's office, and they don't have to honor it. And so if it's older than several years and they don't feel comfortable honoring it, they don't have to. And so that's why we think it's a good idea every few years. I think at least every 5 to 7 years. That's what most of the estate planning attorneys are telling us. You should update your power of attorney documents, even if your wishes haven't changed, just to get fresh dates and signatures on those documents. And it's not real expensive to just have those things reprinted with your same wishes, or even to make a minor change. It's a pretty insignificant cost, especially as compared to the significant cost of adult guardianship. It's several $1,000s to establish an adult guardianship, and then it can be $1,000 or $2,000 or more a year if it's an ongoing incapacity. So I can't stress enough the importance of those living documents. And, of course, working with a professional, both financial professional and estate planning professional, can help you achieve your tax and non-tax goals. Because, again, estate planning is a whole lot more than just about taxes. Okay, let's move now into retirement savings. While we're talking about planning, 2 retirement savings provisions in the American Taxpayer Relief Act, one extended and one new, can certainly help you in your financial planning. One of them is IRA Charitable Rollovers. This American Taxpayer Relief Act extends the popular IRA Charitable Rollover provision that had expired after 2011. Basically, with a charitable rollover, you can transfer directly from your retirement account up to $100,000 completely tax-free directly from your IRA to a charitable organization. Now, we've not had any clients that have utilized this provision up to the entire $100,000. But what's nice about it is, let's say you were going to give money to a charity anyway. If you have that money directly transferred from your IRA to that charitable organization, then you don't have to worry about, did I qualify for the deduction? Are there any issues there? It's direct. It's right off the top. Now, a few things, though, to keep in mind. You have to be 70 and a half or older to benefit from this tax-free provision. If you have a traditional IRA, the rollover amount counts towards your required minimum distribution. For those of you that are approaching or are already 70 and a half, you know that the government makes you take out an amount each year and pay taxes on it to satisfy this RMD, or required minimum distribution. Basically, they're saying, hey, we want you to start paying taxes on this money whether you need it or not. That can be utilized towards these charitable contributions. Well, now it becomes a non-taxable event for you. So if you were going to give a few $1,000s over the course of a year to charity anyway, then this is a way to do it on a tax-free basis and avoid the tax on that required distribution. Now, for higher income taxpayers, the charitable rollover can be more advantageous than making a taxable withdrawal from an IRA and then contributing from the withdrawn funds to the charitable organization. Because the charitable contribution deductions are subject to AGI limits and the newly reinstated limitation on itemized deductions. The opportunity to make the charitable rollover is limited, though. The provision is effective only through the end of this year. Again, we may see them extended another year or not, but at this point, that's undetermined. Now, another big one, and we've seen this with, had a lot of questions from clients that work for large employers, and these are called in-plan Roth conversions. This is really what I see as the second potential planning opportunity, and that involves converting a pre-tax account within an employer-sponsored plan, like a 401k, into a designated Roth account. So under the new law, a 401k, or maybe if you work for a nonprofit, a 403b, or for teachers out there or other governmental 457 plans, if the plan offers a designated Roth account, it can allow participants to roll over money internally to an in-plan Roth account without meeting the usual rollover qualification requirements. So previously, participants had to be qualified to receive a plan distribution to be able to make a rollover to a Roth. If your plan does permit these in-plan rollovers and you elect this option, you do have to pay income taxes. So I mean that we've had a lot of clients that have said, well, I want to change my account to a Roth so I can take the money out tax-free. Well, you can certainly do that, but you have to realize you have to pay the taxes on that amount now in order to enjoy that tax-free benefit later. And of course, you've got to follow some other rules. Generally, 59 and a half or older, the money has to be there 5 years to enjoy complete tax-free withdrawals on the back end, even of earnings included. You've got to meet certain parameters. But if you believe taxes are going to go up in the future, or you want to just protect yourself against future taxes, it could make sense to do some Roth conversions, but you just have to be careful because you could throw yourself into a higher bracket not necessarily knowing that. And then there's no tax due later on withdrawals if the requirements are met, as I mentioned a minute ago. Now, I have a lot of people say, well, what if the government changes their mind? I highly doubt they're going to come back later and assess federal income tax on something that you've already, I mean, that's double taxation. If you choose to pay tax now and then later on they say never mind. But I cannot say that they won't have some sort of means testing or success tax. I mean, there's discussions of them doing the same thing with Social Security. So we certainly can't know what the future holds in that regard. But I personally don't think that they would turn around and charge federal income tax on monies that you already paid federal income tax on to get a tax-free benefit on later down the road. So if this is something that appeals to you or you want to discuss, we can certainly discuss that with you one-on-one. And we have a handful of clients that do Roth conversions every year. They do a little bit at a time so they don't throw themselves into a higher bracket, or at least not into a whole lot higher bracket. And a lot of times it can make sense if your means allow you to pay taxes, especially from other assets. Maybe you've got some money in the bank that's not really making anything anyway, and you still have adequate cash reserves for emergencies and opportunities, and you could take some of that money, instead of putting it to work somewhere else, you just use it to get some of the taxes out of the way on some of your retirement accounts right now. That could be an effective way to make that money work for you a little bit harder by just getting some of the taxes out of the way. But we have some clients that will fill up their tax bracket every year. So let's say that you're in the 25% bracket and you've got another 10 or 20,000 left before you'd be thrust into the next bracket. Well, you could convert 10 or 15 or 20,000 to fill up your bracket, so to speak, without paying additional tax or throwing yourself into a higher bracket. And that may or may not make sense for you. A lot of times at the end of the day when we do analysis for clients, at the end they say, you know what, if I can put off paying taxes today that I can pay tomorrow, I think I'm going to do that. But there can be some benefits, and everything has its pros and cons, and we'll be glad to go over those with you if you'd like to discuss it further. Some of the steps to minimize the tax, I've really already covered these. Spread rollovers over multiple years instead of doing it all in 1 year. And if you have an offsetting deduction, there's been some cases with business owners where maybe they've got a loss carry forward on their business. And so they could convert some money to Roth and not really effectively pay any tax because they've got losses to offset the tax on the conversion. That can be an ideal situation as well where it could really make some sense to do those things. Okay, so I'm going to kind of summarize some of the things and then cover a couple of things that weren't in the slides that I think are important with the new tax laws this year. First of all the prior tax rates remain in effect. To me, that's the biggest change. The rates that were here last year are still here this year. But then in addition to that, the Clinton-era 39.6% rate is going to be imposed on taxable income for those single taxpayers above $400,000, married couples above $450,000, married folks filing separately, which is rare, just above $250,000. This is estimated to raise $395 billion over the next 10 years. So this is going to raise a lot of money. Long-term capital gains and dividends, in summary, a 20% rate is going to apply only for those who are in the 39.6% bracket. A rate of 0 is retained for taxpayers in the 10 and 15% brackets. All other taxpayers are going to maintain the 15%. So this is good news for most taxpayers. This is estimated to raise $55 billion over the next 10 years. A permanent patch is now in place, and that is designed to shield middle-income tax filers who would be affected by the alternative minimum tax. As I said earlier, this is pretty welcome and surprising. A lot of people did not think that would happen. As far as the estate and gift tax, in summary, that exclusion is $5 million, indexed for inflation. And so that's effectively letting people pass a lot more money to their heirs at death without being subject to estate tax. The top rate, as I said earlier, is going from 35% to 40%. A phase out of itemized deductions and personal exemptions is going to be implemented. So, and I don't think I mentioned this, that estate tax top rate going from 35 to 40 is going to raise $20 billion over the next 10 years. Okay, the phase out of itemized deductions and personal exemptions that's going to be implemented, this is going to apply to single taxpayers earning over $250,000 and married couples earning over $300,000. So I'm kind of just summarizing here the bullet points of what I went through in most of the slides. This is going to raise $150 billion over the next 10 years. And by the way, the source of these dollar amounts that they're likely to raise over the next 10 years, got these from Wall Street Journal, Washington Post, Investment News, and the Journal of Accountancy is the source of those potential tax dollars raised over the next 10 years. Okay, let me cover some of the changes this year that weren't specific to the Taxpayer Relief Act, but are questions that we get at the beginning of pretty much each and every year. One is, what is the contribution amount this year for 401ks and most other employer-sponsored plans like 403Bs and 457 plans? So if you're working and you have a plan available to you, that amount this year is $17,500. Of course, you might be subject to a percentage of income limitation as well, but the dollar limit, whatever your plan allows you to put, which, for example, some 403B plans allow you to put 100% of income up to, well, in this case, it'd be $17,500. But if you have a 10, 15, 20, 25% contribution limit in your plan document, it would be that percentage of your income up to $17,500. Now, there's a catch-up provision if you're 50 or older of $5,500. So a total of $23,000 now if you're 50 or older, which is a nice provision. They've talked about lowering that, but that so far has not passed. IRA contributions, as I mentioned earlier, $5,500 this year, so 100% of earned income up to $5,500 may or may not be deductible, but the amount is $5,500, 100% of earned income up to $5,500. If you're 50 or older, there's an extra $1,000 catch-up, so it'd be $6,500 for you. And of course, if you're married, $13,000. So you could put 100% of your income up to $13,000, and it may or may not be deductible, and we can certainly talk about that with you one-on-one to make sure you're not subject to any phase-outs of that deductibility. Another question we get quite often for those of you that are drawing Social Security, but you're not full benefit age yet. So, for example, anybody born between 1943 and 1954, the full benefit age for Social Security is age 66. If you're working and you're not 66 yet, and you're drawing Social Security, you could be subject to the penalty or the withholding that they do if you make too much money in their eyes. That's $15,120 this year. That's just earned income. So your pension income does not count. Investment withdrawals, IRA withdrawals, capital gains, dividends, those do not count. It's just earned income from a job, whether it's W-2 or self-employment. If you make over $15,120, they're going to take $1 for every $2 that you earn over $15,120 this year. Now, if you're in your full retirement benefit age, so if you're in your year of turning 66 and you were born between 1943 and 1954, you can earn $40,080 before you see any withholding. And then once you hit full benefit age beyond that, you can earn as much as you want, and they're not going to take any of your Social Security back. One of the other things I didn't mention that's a big change, it wasn't part of the Taxpayer Relief Act, but it was tied in with Obamacare, and that's the 3.8% surtax. And we've had a lot of confusion from clients thinking that would apply to them when in many cases it will not. But it's basically the way it works is it's 3.8% surtax on investment income. So that includes dividends, long-term capital gains, interest, most other forms of passive income. And it applies to single filers with modified adjusted gross income above $200,000. So it's, if you're single, filing single return, it's $200,000. And if you're a married couple filing jointly, it's $250,000. So if you're below that, you're okay. If you're above that, the tax is going to be assessed on the lesser of your net investment income from those sources I just referenced, or the amount over that threshold. So if you're over $250,000 and you're a married couple filing jointly, you're going to pay taxes on your investment income or the amount you earn over $250,000. And they call this modified adjusted gross income. So if your modified adjusted gross income is over $250,000, you're going to pay tax on the amount above that, 3.8%, or on your investment income, whichever is lower. So it's, the good news is it's the lower of the two. And then there's a Medicare tax of 0.9%. 0.9% Medicare tax, so just under 1%. And this is for single filers making over $200,000 or joint filers making over $250,000. We'll pay an additional almost 1% in Medicare tax, only on the amount above $200,000 for single filers and $250,000 for joint filers. Okay, if I can figure out how to do it, I'm going to open it up for questions, and maybe we can make this work. If you are, and this came from a law firm that we subscribe to their tax service, and basically with minor exceptions, they're saying that if you're a single taxpayer and you are under $183,000, you're going to see very little change. Now, if you're working, you're going to see about a 2% change on your Social Security tax, but that's just because it's going back to where it was before the 2% reduction a couple of years ago. I mean, it's an increase compared to where it was, but it did just revert back to where it was a few years ago before they took that 2% and gave it back to us for a brief period of time. So that's probably really the biggest change that you're going to see if you're under $183,000 and you're a single filer, if you're working. Married couple filing jointly, same thing. If you're below $223,000, you're going to see very little change. So to me, that's good news for most folks. The folks that are affected in a pretty big way. Fortunately, a lot of taxpayers will see very little change other than the 2% Social Security increase, reversion back to where it really was supposed to be for those of you that are still working. Okay, question is, second marriage, community property, what happens if there's no will? I believe if there's no will, it's going to revert to the probate statutes, and I believe, don't hold me to this because I'm obviously not an estate planning attorney, but I believe, now it depends on, if we're talking about Texas, I believe the Texas probate statutes state that goes to the spouse if there are no children. If it's a second marriage or beyond, and there are children from a prior marriage of the decedent, then the children, I believe, own 50% of any assets of the decedent, and the surviving spouse owns 50%. So this is why we preach that it's so important to have a will, especially if you have children from a prior marriage, because your new spouse can all of a sudden be half owners of their home with your children from your prior marriage, and that may or may not be what you actually wanted. Whereas earlier, one of the things I said is in the will, you can dictate who you want to get what and when. If you don't have a will, the probate laws in your state dictate, and I believe that's what they dictate. If there's not children from a prior marriage involved, I believe it all goes to the spouse, but don't hold me to that, but I'm pretty sure that's the case. Okay, next is just a thank you message. What a great service. Thank you very much. I appreciate the positive remark there. Wife does not work. Can I still contribute the full amount into an IRA? That comes from Brent. It depends. If your spouse, well, if one of you has earned income, if either of you has earned income, then you can contribute to an IRA up to 100% of that earned income amount. So let's say you're retired and one of you worked part-time and made $10,000. Well, you can contribute $5,000 to 2 different IRAs, and it will likely be tax deductible if neither of you has a plan at work. So I'd need more details to give you a real concrete answer, but even the spouse that doesn't work can make, usually, there are some phase-outs, but they're pretty high, a spousal contribution. And I don't have the phase-outs in front of me, but they're over $150,000 for a married couple filing jointly. Okay, and I meant to cover the next question at the beginning of the webinar, and I completely forgot. And this question comes from David. Is the webinar recorded for review at a later date? And the answer is yes, subject to compliance review. Sometimes they let us provide that full program for use again later to people that missed it or want to re-review it. Other times things have to be edited out, and other times they say, sorry, too bad, you can't use it. I'm hoping they allow us to use the full thing. So my answer, David, is yes, and it will probably be available, and it certainly will be. If at all possible, we'll make it available. Just shoot us an email and let us know. We'll be glad to provide that to you. It may or may not have the video part. If compliance allows it, it'll definitely have the audio part. Okay, and then a question from Brent. I'm maxing out my 401k, so I can't put IRA in my name. If you're maxing out a 401k, it doesn't necessarily preclude you from contributing to an IRA at all. You just might not be able to make a tax-deductible contribution to the IRA. Therefore, it may or may not make sense. A Roth might make more sense, by the way. But I'd be glad to talk to you one-on-one about that, because it depends on the income, how you file your tax return, and whether you're subject to phase-outs or not as to whether it would make sense. But anybody can contribute to an IRA as long as they have earned income. They just may or may not be able to deduct it. And in many cases, I don't recommend it if you can't deduct it, because I think there's other things that might be more advantageous. But Brent would be certainly glad to look at your situation and see if you're subject to phase-outs and what might be best for you. All right, thank you so much for attending. Again, if you have follow-up questions, we're having a birthday lunch for one of our employees right now, so we'll be out for about an hour. And then I'm out the rest of the afternoon, but we'll be back on Monday, and we'll be glad to take any individual questions that you have. Just feel free to call the office. If we're on the advisors are on the phone with a client, we'll be glad to call you back and address your questions one-on-one. Thank you very much, and have a great weekend, everyone.